Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Chris Ray Poniotu, certified financial planning professional, the Cap and Capitalize. And on today's episode, we are going to get into wealth wisdom, mastering the 5 rules of money. But before we get into the 5 rules of money, the free tip of the week. When you find a few great business partners, keep them close and don't look any further. So think about it for a second. How long does it actually take to build a wonderful relationship? Really, regardless if you're in business or not, but this is going out in particular to the entrepreneurial minds and business-minded people out there, okay? In most cases, at a minimum, it takes years to build a wonderful relationship, let alone get a referral from those relationships. And so, and actually, there's a rule out there. It's called the rule of 3. So in year 1, you become known. In year 2, you become trusted. And then in year 3, referrals start to come in from your initial clients in year 1, as well as referral partners that have just started to trust you. And then year 4 after, it's kind of game over, okay? That's going to be explained a lot more in my book coming out in December. Wink, wink, nudge, nudge. So if you have a few quality relationships that are referring you more opportunity than your 4th, 5th, 6th best partner out there, why are you wasting your time? Get really concentrated on the people that want you to succeed the most. So now that free tip is out of the way, let's get into mastering the 5 rules of money. So rule number 1, spend less than you earn. So many people focus on wanting to make more. But imagine if the easiest way for you to do that was to actually spend less. I know, it's crazy. And it's actually pretty easy because unlike trying to figure out where you're going to go to make more money, you already know what you're spending. Look at your credit card statement, look at your bank statement or the checks that you're writing or ACH or whatever the case may be, and you can quickly find a ton of dollars within your spending. And we've talked about this on past episodes ad nauseum. So if you're interested in the expenses side of things, go back to Capitalize Your Expenses, listen to that episode. But the point is, by simply spending less and cutting your expenses, that is an easy way for you to make more money. Now, elaborating on this further, we are in a world where we live for experiences or live in the moment and need to buy that next thing, whether it's a bigger house, a bigger car, or a nicer car, or nice clothes, redesign your favorite room, you name it. So think about this. What if you kept the spending habit, but instead of wasting it on material things, you invested into businesses that would produce enough over time to buy all of those things for you? And there was a time, just to give you an idea, where my wife and I, we went to dinner, and one of the table members was saying that when, and it was kind of like almost like a, oh, look at me, like a flashy thing. Like, when I want to buy something, I'll buy it. I remember that was the quote. And again, it was kind of like subconsciously arrogant. And I can tell you, in 10 years, that mentality will hurt that guy big time. I would much rather fast forward in 10 years and have my wife and my investments pay for our lifestyle, not us directly. You see the difference? And that's when life gets to be really, really fun. So it's the whole idea of the short-term pain for the long-term gain. So if you're spending less, that is the easiest way to make more. So the second tip in the second rule of money, I should say, don't focus on what to do to be successful. Focus on what not to do, and you can't help but become successful. So I'm going to read that one more time because that was a mouthful. Don't focus on what to do to be successful. Focus on what not to do, and you can't help but become successful. So it's a bit of a reverse engineering of the mind, as you're really saying the same thing. However, if you think about it for a second, so many people are trying to just hit the next home run, whether it's invest in the next Amazon or Apple or Google or Tesla or whatever the case is, or they're trying to hit that big client that they're trying to land that'll just revolutionize their life, or that new job that they've been gunning for, or buy that new house, you name it. But what if you flipped it and you said, okay, instead of investing in the next Amazon or Google or Walmart or whatever the case is, why don't I just make sure I don't invest in the next Peloton? And for those of you that are unaware, Peloton stock has lost 99% of its value since the height of COVID, which is not a recipe for success. Okay. That mentality of avoiding the not to do's is going to carry you in the long run. And by the way, that is by no means an original idea by me. That is that's an idea that Charlie Munger, Warren Buffett's business partner, had, and he spoke about it at the University of Michigan years before he passed away. And his whole thing was, my entire life, all I did was try to avoid what not to do. And another way he said it was, tell me where I will die so I don't go there. So if you can do that, by definition, you are going to be successful. So before we get into the next three, we're going to take a quick commercial break. And then when I come back, we're going to close this puppy out, and you're going to be well equipped to handle the 5 rules of money. So stick around.
Capitalizers, this episode is sponsored by the best-selling book, Capitalize Your Finances, the how-to framework that takes you from compoundingly clueless to monetarily magnificent. Regardless of where you're at in your financial life, whether you're just beginning to express interest and commitment to your personal finances, at the pinnacle of your career, winding down into retirement, or thinking about your legacy for future generations, this book walks you through every step of the way so you can succeed on your terms and with your own values and passions guiding you. After reading this book, you will officially have Christopher A. Panayotu, the Cap in Capitalize, in your back pocket, guiding you in detail through every step of the way so that you can take charge of your finances, not the other way around. Head on over to Amazon.com today and start capitalizing your finances to the fullest with this incredible book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. And now, back to the episode.
Welcome back to the show. I missed you dearly, and we are going to close out this episode with the last 3 of the 5 rules of money that you need to master. So with that, we are going to dive into number 3, which is save and invest wisely. So this is both pretty obvious, but it's also not so obvious. And I want to go over the not so obvious more so, because everyone has heard to some degree save and invest, save and invest, save and invest wisely. Most people, and for those of you that are committed listeners, you know how I feel about diversification. Most people think that it is all about diversifying your portfolio, and that's not necessarily the most optimal way to invest. And think about it for a second. If you have 400 investments within your portfolio, and let's say it's perfectly diversified, so each one gets a tiny little sliver of your money, and one does really well, it's up 100 times, you're not really going to feel it. In fact, I can tell you you're not going to feel it. But if you had 10 investments and one did really well, like 100 times, you are going to feel it. And you're going to feel it in a great way. You are going to be ecstatic. Now, the mainstream media will push back on me saying that this is really imprudent of having a concentrated portfolio, whether it's of stocks, quality real estate, privately owned businesses, lending, hedge funds, whatever, long-term investments. But I've got news for you. It's not imprudent. So according to a study by University of Pennsylvania's famous business school of Wharton, once you have five stocks that are different businesses in different sectors within your portfolio, anything added to that provides next to zero added diversification benefits. Now, this was written in Joel Greenblatt's book, who I'm a huge fan of, You Can Be a Stock Market Genius. It's a great title. Who I might add, okay, because who is Joel Greenblatt? Yes, he's an investor, but he's no ordinary investor. He earned about 40% returns when he ran his hedge fund Gotham Capital, which, side note, is like the coolest name. All these financial terms in like venture capital firms have the coolest names, okay? I had to settle with Capitalize Your Finances, but, such is life. But the whole point is, save and invest wisely. Yes, that's absolutely true. But when you dig further, you actually find the real truth. Now, when it comes to stocks, privately owned businesses, real estate, I would tell you that, okay, you only need to be right a couple times. Like I said with Joel Greenblatt, he was famous for having 5, sometimes 3 stocks in his portfolio, which was hundreds of millions of dollars. And he earned 40% over that period of time. I think it was like 8 or 9 years before he closed out the fund, and now he manages his own money. Okay. Awesome life. The American dream. The only exception that I want to caution you with when it comes to having a concentrated portfolio, the exceptions would be, and there's really 2 that I can think of off the top of my head, bonds and private credit, which is another form of business debt, not death, debt. And the reason for that is, and I've just seen this within my practice, if you go, and let's just take private credit, it's a business loan. So if I go and lend, I'm going to take my brother's business, right? If I lend my brother money and I'm earning 10% on my money due to where interest rates are, okay, that's fantastic. But if his business goes under, I'm screwed. Like, I'm not getting that principal back or my income. And so with private credit, that's the exception of it where I would say, okay, you really would want to invest in the sector as a whole. And you would want to invest in a number of different businesses from a diversification standpoint, or maybe even a fund. And in fact, I would argue a fund, because that takes a very select mind to understand how to value those businesses to make sure that they can pay you back. And so you're earning the return as well. And it's got to work for the business. And it's the same thing with a bond. Now, I'm not necessarily a bond fund fan, and I'm not going to get into the weeds of that because that dives down a rabbit hole. But I can tell you, unless you're utilizing like government bonds, which are contractually guaranteed by the U.S. government in this case, it gets really dicey if you're utilizing individual bonds at, let's say, a local municipality or a business that maybe is a little bit shaky. It's the same thing with private credit. So again, unless you really know what you're doing, those 2 investments are the one exception I would make when it comes to diversification being extremely valuable. Now, the 4th rule of money that you need to master is manage debt responsibly. And there's both sides of the aisle when it comes to debt. There's the Dave Ramseys out there where all debt is bad. If you have it, you're going to be punished to hell and you're an absolute idiot. And then there's Robert Kiyosaki, who I'm pretty sure would have debt tattooed on his back, maybe a little bit lower for those that are keeping it PG-13. And he is all about it. And those both are dead wrong when it comes to the extremes. Like, they are so wrong. On one end, you're losing millions of dollars at the emotional unintelligence when it comes to being quote unquote debt free. That's Dave Ramsey. And then on the other end of the spectrum, you are basically dancing with fire by just digging yourself and digging yourself and digging yourself into debt, praying to God that you're going to capitalize on the spread, which is the debt return that you're paying, and then you turn around and you earn a higher return on that debt. So if you took out a 6% loan to earn 15%, you just earned a spread of 9. Okay, that's Robert Kiyosaki. That is also very deadly, okay, and much more obvious than the Ramsey. Now, when it comes down to debt, you live and die by the rule of 6%. And the reason for that, and I've written about this in my book extensively, when it comes down to debt, do you think you can earn more than 6% in the long run net of tax? 6 to 8 is the range I would give you, but let's just use 6 for simplicity's sake. Could you guarantee it? Nope. No, you cannot. You cannot guarantee a 6% rate of return in the long run. Okay? So by doing that, if you ordered your debts for highest to lowest and you took that highest interest rate debt, paid it off first, and then snowballed that into the next one, until you have debts below 6%, I would say that is a pretty prudent strategy. But then when you have debts below 6%, what do? Don't go Dave Ramsey on me and just pay off all the debt. That's not going to be the ticket that's going to get you to heaven, okay? What you need to do then is take that money that is coming to you in free cash flow, and that's where you supercharge that from a rate of return standpoint. So do we think we can earn a larger return than 6% in the long run within your 401ks, IRAs, investment accounts? Yes. Can I guarantee it? No. But the longer that you have, the better chance and probability that you have of earning a return higher than 6. Again, compliance, get it out of your head. I'm not guaranteeing this. I'm just stating the obvious. So that's when it comes down to managing debt responsibly. And the fifth and final rule that you need to master when it comes to money: never stop educating yourself. Money consistently changes. And I'm going to give you actually a high-level example of what I mean by that within my practice. So this is being recorded in 2024. 5 years ago, it was 2019. That's how math works. And at that time, in 2019, interest rates were lower than they are now. And they were going lower. And so when it came down to intermediate types of money, which for clients that are retired, you don't necessarily need it today. So you can take a little bit more risk with it, but you can't just completely blow it, right? It's an intermediate type of money. We were using preferred stock strategies, which are very useful when it comes to planning at that time. Well, as of today, and let me backtrack. The reason why we were using preferred stocks, it's very simple. We were trying to earn around the 5% range, and how preferred stocks work is you take your money, you invest in the preferred stock. It's not publicly traded. It's semi-illiquid, so it's not like on the stock exchange, so to speak, and there's no real volatility. You put your money in, you earn that return, which has historically been around 5 to 6%, and then after the given period that was stated within the agreement, generally it's about 5 years, you have the ability to get your principal back without any penalty. And so we would use that for clients when we knew we couldn't risk that money, but we could rev the engine a little bit more than like a savings account. Well, you fast forward today, a government bond is paying 5.5%. CD money markets they're not paying as much, but they're paying pretty close. And so what has happened over time is preferred stocks, from a risk standpoint, you're taking too much risk. And so that has been put off to the wayside. And now you've got immediate types of monies, which again, I reference this in my book a ton, where you've got bonds, CDs, and money markets that are actually paying intermediate-like returns. And so you don't necessarily have to reach for the risk to get that type of money, which is kind of cool, because by taking less risk, you can actually take more risk in the long run and get really creative from a planning side of things. Now, the reason why I bring that up is that's much easier to just say, oh yeah, times change, money changes. There's another example that I wanted to relay before we close out this episode. So back in 2022, one of my guests, Adam Cecil, wrote an amazing book, Where the Money Is, Value Investing in the Digital Age. It's one of my favorite books of all time. And up until I read that book, in my practice, I utilized, not solely, but I utilized a lot of real estate when it came to the alternative investment sector. And again, I wasn't like a real estate guy. Initially, there was some sales strategy because I was providing what other advisors were not. And then what happened was interest rates started to collapse. And when interest rates collapse, real estate tends to do really well. And so no one got hurt, but we kind of got away with better returns than historically. And when I read Adam's book, I realized, whoa, the core strategy should not necessarily be real estate for long-term success. It should be investing in businesses. I mean, think about it for a second. Real estate historically grows at around 4 to 5%. And let's say that from a rent income standpoint net, you're earning about 4 to 5%. So that's a total of an 8 to 10% return. Is that guaranteed? No, but I'm just going off of history here, averages. Well, if you think about businesses out there, unlike real estate where you can only really control the real estate in comparison to what is around you, a business you can control to the nth degree. As a CEO of your destiny, you can do a multitude of things to your business. And so in Adam's book, there's an amazing graph on growth of historical inflation, growth of real estate, and then a growth of the most successful businesses in, I believe it was just the United States. And so just by looking at that, I go, oh my gosh, that makes total sense. And I've even thought about this with my own business. My own business has grown at a rate significantly faster than like our home value, even with home values exploding right now unnecessarily, that's a whole nother part. But the moral of that story is I've never stopped educating myself on this. And even being the Cap and Capitalize, okay, I am never going to hold myself out to say, oh, I know all. I am just being a steward of the education that I've been blessed with, and I'm gifting it back to you. And it allows me to become a better teacher, and the better teacher you are, the better student you become as well. It's a lovely circle of life. So never stop educating yourself. And so with that being said, that wraps up Mastering the 5 Rules of Money, Wealth Wisdom. As always, I'm your host, Christopher A. Paniotti, the Cap and Capitalize. I miss you dearly, and I'll see you next week. Keep capitalizing, my friends. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher A. Paniotti, Certified Financial Planning Professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Alternative investments may not be suitable for all investors and should be considered as an investment for the risk capital portion of the investor's portfolio. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest interest rate, financial, inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. Municipal bond interest may be subject to the alternative minimum tax. Money market mutual funds, though traditionally lacking federal insurance, are not without risk and are highly regulated under federal law. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. There are two types of equity, common stock and preferred stock. Preferred stockholders have a higher claim to dividends or asset distribution than common stockholders. Preferred stocks are sensitive to interest rates. The share price generally falls as prevailing interest rates increase. Other risks include perpetual life or very long maturity, a call feature, low credit standing, deferrable dividends, and, for traditional preferred stocks, depressed yield due to demand for corporations that receive favorable tax treatment. The details of each preferred stock depend on the issue. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Christopher A. Paniotu is a registered representative with, and securities offered through LPL Financial, member FINRA SIPC. The opinions voiced in this program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. The people and companies mentioned in this presentation are not affiliated with or endorsed by LPL Financial or Capitalize Your Finances.